and that team have moved under the Sequoia brand to create Sequoia Asset Management. Main goal of moving that company into that group was that they specialise in buying property for self-managed super funds, and we were obviously equities. Back in 2009, around about 5% of our investors were actually investing through their self-managed super fund. In the last 2 years, though, it's more like 90% of investors now are using their SMSF. So investment advisors have been upskilling themselves on the SMSF space over the last few years so they can provide greater investment advice to their clients. Our clients have been demanding more of a broader spectrum of investment offerings as opposed to merely capital protected or share investments. So we can now, with the team at Sequoia, offer investors buying direct property, also borrowing to buy direct property in that group. JBG Structured Investments, which is predominantly me, and Marcel Collingwood, one of the other senior investment managers that was at JB Global, has created JBG Structured Investments. So JB Global was separated into two entities. The investment advisors went into Sequoia Asset Management, and our investment expertise and product issuance for the capital protected investments became JBG Structured Investments, maintaining the JB logo and brand. So today I'm going to go through an update as to what the market's done over the last 3 years. Unfortunately, for our investment, the ASX has gone down in value. The underlying investment was linked to the ASX200 being Australia's largest 200 listed companies, and I'm sure, as you're aware, the ASX200 is below our entry level. I'll go through that now. So while the investment underlying has gone down, our investment itself has actually performed exactly the way it was designed to. One of the key features of the investment was the capital protection feature. A capital protected feature meant that I think the average investor was around $100,000. That 100 grand was capital protected. So while the market is down around 10%, you basically walk away from that shortfall. So the capital protection, or the insurance, has worked exactly the way it was meant to, which is good. So while we can't control the market, unfortunately, what we can control as investment managers is our risk management techniques. And look, I applaud you for recognising that by being investors in either Series 1 or Series 2 investments. So look, I'm not here to hand out big checks. We haven't been able to pull a rabbit out of the hat. If the ASX 200 didn't go up, we couldn't make a profit. So while it's capital protected, you borrowed the full amount for the majority of investors, which means that you're out of pocket the interest expense. So just in summary, the interest expense was 4.5%. The total outlay was $15,700 for a total of a $100,000 investment. That is obviously at risk. The interest expense, the bank isn't going to be reimbursing that. So the downside risk has been about 5% per annum. For the majority of you should have been able to claim that as a deduction. So if you're in the highest marginal tax bracket, the after-tax loss has been around 2.65%. So there's no gain. The loss has been minimised because we had capital protection. It's been minimised to the interest obligations. As I said, that should have been deductible. So rather than merely walking away, saying, hey, we've lost money, what we're looking at doing as investment managers is to give you an opportunity to make a return from the investment. And I'll go through your options in a moment. Now, in these times, I'm regularly reminded to be a patient long-term investor. So what we anticipated to happen with ASX to increase in value hasn't occurred over the last 3 years. In fact, it's a lot lower. Where Warren Buffett comes out and states that look at market fluctuations as your friend rather than your enemy. Profit from folly rather than participate in it. So the fact the market is cheaper, and I would argue that a lot of the fundamentals of our Australian share market have actually improved dramatically over the last 3 years. What we're looking at doing is giving investors an opportunity to extend the investment term by 3 years and also re-enter the market at the lower entry level. Before I get into that, there's a few things I want to cover off. Sequoia Asset Management, so that's the new Australian Financial Services license. We deal in the financial products. Obviously, we get a performance fee out of the investment. The last 3 years I haven't worked for that much, but I suppose I'd argue as an investor I've been paid what I deserved. You guys haven't made any money, so we haven't been paid any performance fees, and I think that's the way it should stand. Tonight is just about general advice. What I mean by general advice is obviously we haven't considered your individual investment circumstances. And that's how our company operates at all levels. We don't give personal investment advice. We're not financial planners. We specialise in our investments. Our job is to educate you so you can make an informed investment decision. Our belief is you're the person that can make that best decision for yourself. General promotion purposes only. The sample strategies, case studies, they may include a few assumptions, but we'll talk through them at the time. Following on, like if you did want to participate in what we've called the roll down, you can gain a product disclosure statement by speaking to our investment managers. So Warren Buffett, well, never lose money, and two, never forget rule number one. We're all told this, and it's a quote that I often use. Warren Buffett has lost a lot of money over the last few years, and a lot of the companies, not all of his companies go up in value. But I suppose what he does when the market actually does go down from his entry level is he maintains a long-term view and remains a patient long-term investor. When we all invested this in 3 years, and I went around the countryside talking about it, I mentioned that, look, the 3 years isn't the maturity of the investment. While it is the maturity on the basis that you will need to be making an investment decision at that time, you will be given a few options. Those two options was if the market or the investment was up, would be to participate in active management. If it was up, we would be talking about tonight locking in gains. If it was down, though, we'd be talking about rolling down, which is exactly what we're giving you as an option. So look at market fluctuations, your friend rather than your enemy. Profit from folly rather than participate in it. The key features of the investment, if you remember 3 years, is that it was a high growth investment and that it gave you exposure to the Australian share market, ASX200. There's 4 risk management techniques built into the investment. I'll go through those in a moment. But the main one was obviously that capital protection, which has minimised our loss. At least there's no capital loss on the investment. You had to borrow 100%. The interest rate was 4.5%. You could borrow 100% within your SMSF if you had a self-managed super fund back then. You had to prepay 3 years of interest up front, which was 4.5%, plus an application fee of 2.2%, which helped us recoup some of the cost of putting the investment together. Every 3 months you could have redeemed the investment. However, that was more of a profit-taking mechanism because the bank, there was no guarantee that you would get any of the prepaid interest back. That was a 3-year term. So that 3 years is actually coming to an end in late December, early January. The key risk, the counterparty and credit risk. This is an investment-grade bank. I think for Series 2, the counterparty was Royal Bank of Scotland, RBS, or Merrill Lynch. So either one, their credit rating is quite high. They're the leading investment banks in the world, which has been a concern prior to 2009. That Bank of America owns Merrill Lynch and the UK government owns pretty much the majority of RBS. So we thought it was a good counterparty. And the counterparty risk would have only occurred if one of those banks went broke and could not fulfill its obligations of the investment. But over the last 3 years, while many people back in 2009 focused on counterparty risk, that hasn't been a risk for our investment, and they still have fulfilled their obligations on the investment by maintaining that capital protection. Capital protection was only valid at maturity, which is in 3 years. Had you chose to redeem early, while you had the benefit of the protection, you could have walked away, you would have lost the interest expense. So again, the prepaid interest was the maximum amount you could have lost over the period plus that application fee. Tax risk refers to what we said that there was a high chance of receiving the interest expense as a deduction. We didn't have an ATO product ruling, so the ATO can change their opinion on interest expense on your investments. But again, I haven't been made aware of anyone not being able to claim the interest expense as a tax deduction. Exposure and volatility risk. How we manage the investment is through the ASX200, and then we actively manage the investment in accordance to our volatility, in that we believe our volatility and market performance are inversely correlated, in that when times of volatility are high, markets generally go down in value, so we want minimum exposure to the investment. Conversely, when our volatility is low, markets generally go up in value. But again, this is more of a profit-enhancing mechanism because the investment is down. It hasn't had any impact on our investment. Leverage risk, obviously the more amount you borrow, the greater the interest expense, therefore the greater dollar risk for the investment. So the 4 risk management techniques, first and foremost, was capital protection. The capital protection, just like insurance on the investment, means that while the investment's down 10%, you can merely walk away, which is good. There's no shortfall that you owe the bank. The non-recourse loan meant that if there was a problem with Merrill Lynch or RBS, you could walk away from the investment and the loan. That non-recourse loan meant that it was eligible to borrow within SMSF, and also for insurance against, I suppose, the insurance provider, the investment bank. Dollar cost averaging, we entered the market over 3 months on 3 separate dates. Also, when we're exiting, we've been exiting over the last 2 months, with the final one happening early January. Volatility management, I just discussed that to minimize the usual risks associated with volatility. So there are 4 risk management techniques. This is when we invested. If you go back to 2009, it was for Series 1 in October, Series 2 there in early January. The market was just above 4,800 points. Today, well, this actually isn't quite updated. The market is up a little higher. We're back to close enough to 4,500 points. So we're up around these levels. So we've had a bit of a bounce from the lows, which is good, but we're still nowhere near the 4,840 or 50 mark. So the investment's down, trading around 90 cents. It's down about 10% as a result of that. So as you can see, we've seen times where the market rallied back to 5,000. 5,000 had hit a few times or close enough to it since we've actually been exposed to the investment. 5,000 has been a resistance for us for quite a period of time, and around 4,000 points has become a support level. Again, nothing exciting there over the last 3 years, where there's been a bit of pain associated with it because we haven't made any money during that period, despite the overall market in ASX200 showing signs of a recovery. What I mean a recovery is that this is the company profits before tax, as according to the ABS, Australian Bureau of Statistics. As you can see, since 2001, profits have increased. So this goes back over a fair period. Profits have gone up. Now this is pre-GFC, in this rally prior to 2008. There's a fall as a result of the global financial crisis, and since then you can see profits are back to close enough to all-time highs. Profits are back to those levels that they were prior to 2007. So what we anticipate is company profits to increase across the board, which has occurred. Now I know there's different sectors that profits aren't anywhere near as high as what they were in 2007. A good example of that is the retail sector. David Jones, Myer, Harvey Norman, JB Hi-Fi, Billabong, look, all their profits have declined. But this is the market. So overall, our economy is actually looking not that bad. Retail sales, I suppose it's going through a systematic change in that more and more people are becoming more and more comfortable with buying on the net, and that's having a huge impact on those retail profits. So what I'm looking at here is the ASX200, the good exposure to it is that it should give you a fair indication of the overall economy. You're not taking sector-specific risks. So if you look at that retail, if you go to the other end of the spectrum, we've got the top 4 banks, for instance, that makes up about 35 or 40% of the ASX200 if you add CBA, NAB, ANZ and Westpac together. Their profits are at record levels. They're making more money than what they did back in 2007, which is interesting. If we go back to 2007, there was a huge amount of competition that existed for the top 4 banks. Like we had Bankwest, Rams, Aussie, Wizard, St George. There was a heap of second-tier lenders that were providing competition for the banks. Now Rams is owned by Westpac, St George is owned by Westpac, Bankwest is owned by CBA, Aussie is majority owned by CBA. So the top 4 pretty much control the entire market. They've been able to pick up ample market share during this time, which means in days like today when the RBA drops interest rates by 25 basis points, they don't necessarily need to pass on the full rate cut. That margin has generally gone to profits, as we're seeing with the profits of the top 4 banks in that time. So profits have increased since 2001, yet this is the performance of the share market. Now, as an economist, I like overlaying 2 charts and to come up with a story. So if we overlay profit and price, price is measured by the ASX200 and profits by company profits before tax. Orange line is the company profits. As you can see, it increased and the market also increased over that period. Generally, the market overreacts on both scales as motions of investors dictate their decisions. So when the green line is below the orange line, the market is deemed to be undervalued. When the orange line is below the green line, the market should be perceived as overvalued. I think that made sense. So the green line below the orange line is cheap. When the green line is above the orange line, it's expensive. So as we can see here, during 2007, this period here, the market got ahead of itself and was being overvalued in accordance to profit. Now, the only true long-term dictator of price is profit. If a company can't make money, it'll eventually go broke. If a company makes a lot of money, then the share price will eventually increase in value. So over the long term, profit is the only dictator of price. In the short term, though, the market is dictated by the noise or market sentiment. As we've seen over the last 3 years, there's been a fair amount of noise that's existed in the marketplace. As the Australian share market has been plagued from uncertainty over in Europe, initially America, and also the slowdown in China. Now, it's interesting where every month we seem to hear the same news out of Europe saying there's issues in Greece. It's the same news we've heard for 5 years now. In fact, the Greece economy, when you measure it as a size of GDP, is in fact now smaller than New Zealand. Yet, look, if there was a problem in New Zealand, I doubt global economies will be dictated by fear as much as we've seen over the last 5 years, especially when you look at the Australian share market. So the main reason the green line is below the orange line now is simply because of the fear associated with people's investments. The further the green line is below the orange line, the cheaper it appears to be. So today where we're at, the green line is at its biggest gap to the orange line. It's at its biggest discount that I've seen in history. Now, if you go back to 2009 when we invested, look, there was a gap and we expected that gap to close up and the market to rally, which hasn't occurred because of that fear. But I think eventually over the long term, the market will dictate profit as opposed to the fear. We'll stop worrying about Greece. Hopefully the politicians will put running the economy ahead of politics sooner rather than later, and we'll see Greece either get kicked out of the euro from a currency perspective and be able to start running on its own 2 feet. So I expect those things to occur soon. If you look at the issues that have plagued America, obviously American unemployment, I'll do a direct comparison between Australia and America in a moment, but all our worries about the United States back in 2009 haven't come to fruition. In fact, the United States share market is almost back to all-time highs. It's almost back to that pre-2007 levels, but I'll show you those charts in a moment. So when you compare price versus profits, our market looks very cheap where we're at the moment. So this is the US versus the ASX 200. If you go back to when we invested around these dates. What are we talking about? About here? Oh, where are you? About these levels. As you can see throughout history, the American share market and the Australian share market generally track each other. This is from the highs back in 2007. Share markets, both of them fell about 50%. The United States share market recovered, ours did, and as you can see, in the last 3 years, the American share market has increased substantially and our market has gone down in value. If you look at the two, our market should be facing high unemployment, low interest rates, high economic deficits, and huge economic problems, especially when you compare it to the United States, because our market's trading at it needs to increase by about 50% just to catch up to the Dow Jones. So if you look at that, our market should be the worst economy. But let's look at the key statistics and make a direct comparison. The unemployment in the United States is around 8%. Here in Australia, it's about 5%. So our unemployment is a lot less than the United States. Looking at these economic statistics, our market should be a lot higher than the United States. Inflation. Inflation in the United States is about 1.5%. Here it's 1.2%. As you can see, it's not so much the inflation rate, but how stable the inflation figures are that's more important. Ours have been a lot more stable than the United States. On inflation figures, our economy should be a lot more stable than the United States, and our market be a lot higher than where the United States is. Many people thought in the United States, because of QE1, QE2, and now they're up to QE3, which refers to quantitative easing, printing of money, they thought that the flow-on effects would be that inflation will skyrise. Yet inflation is quite low. Those problems haven't flowed through to the economy. GDP growth. If we look at GDP growth in the United States, they had, what, 1, 2, 3, 4, 5, 6. 6 quarters, consecutive quarters of negative GDP growth. In Australia, we had 1, 2 in total. We avoided a recession. If you look at GDP growth, then our economy and our share market should be a lot higher than where we are today. Yet, despite all of that economic statistics, the Australian share market has lagged the performance of the Dow Jones significantly. The United States share market is almost back to all-time highs, yet our market is merely traded sideways. Again, for us to catch up to the US share market, we need to go up 50%, over 50%, just to catch up to the United States. This is the performance of the Australian share market over the long term. It goes back to 1900. So as we can see, every point on that chart, all of these details, is a crash. The market needs to fall by 20% for there to be a crash. Throughout history, the longest recovery to an all-time high has been 7 years. Now today we sit here from the highs of the market, which was back in 2007. We sit here 5 years on. It's now just over 5 years since the high of the share market, which means unless our market recovers, and needs to go up 50% to do so, unless our market goes up 50% in the next 2 years, our economy or our share market has been the slowest recovery ever. Worse than the 87 crash, worse than the 74 oil crisis, and worse than the 30s recession. Now looking around, I don't think it's that bad. I don't think it's as bad as the depression back in the 1930s. In fact, if you look at the statistics before, our companies are making more profit now than what they did previously. So look, I sit back here, like you, I'm sure, scratching my head, wanting to know why the performance of the Australian share market hasn't gone up in comparison to the United States, if not more, in the last 3 years. But also look at the probability in that even if it does go up, it doesn't go up 50% in the next 2 years. Let's say it goes up 25% in the next 3 years. We can make substantial profits from that. And if it only goes up 25%, then we are the slowest, longest, most painful recovery in history. We're still a long way to go before we get back to those highs. But even if it only goes up 50% of that, 25% or close enough to 7% per year compounding, we can make serious profit if you participate in the roll down. This is ASX performance since 1980. So rather than looking at it over a 100-year period, let's look at it over the last 30 years. Last time we had these sort of corrections was back in 87. Again, 7 years on, we're back to all-time highs. September 11, you can see the market recovery. Like these gains here are huge gains on the market. And the time to be looking at, appreciate those gains, is to have the capacity to buy when no one else is doing. On volume, the amount of buyers in the marketplace in the Australian share market these days are at its lowest levels in history when you compare it to per capita. This is a chart that I just pulled together this afternoon. I pulled it together this afternoon because I wanted to look at the last time the RBA dropped interest rates back to 3%, what the Australian share market did. In fact, if you go back to the date that the RBA dropped interest rates to 3%, it was back in March 2009. March 2009, the Australian share market, as measured by the ASX200, was about 3,150 points. That was almost its all-time lows. Today, the RBA just dropped interest rates by 25 basis points, back to 3%, which is the lowest level it's been in quite a period of time. It's back to those levels in March 2009, where the market rebounded. What we go on 15 months later, the market rebounded 50% in less than 12 months. That rebound occurred simply because our market was so undervalued. People realized having money in a bank account wasn't going to give them a huge rate of return. With interest rate in the bank now earning you 3% and inflation being the same amount, the return on your cash is almost zero. Because the return on cash is almost zero, we're seeing a lot of people considering growth assets like shares and property to invest in, simply because the returns of having in a bank account, sure it's more certain, but having in a bank account isn't providing the huge returns that they're going to need to reach whatever investment goals they have. So in 2009, we saw that a lot of people injected their money back into the ASX200. If that's an indication of what we've got to enjoy over the next 12 months, then that's going to be pretty good. If you go back to March 2009, 12 months later, the market was up 50%. Hopefully, the next 12 months is certainly something like that. If we do, we're back at all those all-time highs. Even if it does just a marginal amount, if it recovers by 5%, our investment follows the same way, you're going to be breaking even. So you look at the economic statistics, it's all pointing towards a recovery. Hopefully, look, my crystal ball is as clouded as everyone else's. There's things that I know and things I don't know. Things I don't know is what the share market is going to do over the next 3 years, 12 months to 3 years. In fact, anyone that tells you they do know are just guessing and will soon be proved wrong. But what I can look at is what I do know. What I do know is the last time the interest rates were at these levels, the market rallied a huge amount 12 months following. What I do know is that over history, markets don't stay this cheap for long. What I do know is company profits are almost back to 2007 highs, yet our share market needs to go up 50% to get there. What I do know is I only need 4.95% per annum if I'm borrowing the money to break even on the investment. That's what I do know. What also I know is that if I'm wrong and the market goes down by 50%, then we've got capital protection like we did 3 years ago. Therefore, the maximum amount I can lose, I know at day one, is 4.95% per annum. And that should be tax deductible. So if you're in the highest marginal tax bracket, the after-tax cost is around 2.65% per annum. That's what I do know. So all the statistics is there. But look, let's have a guess. What I want you to do, just to be a bit interactive, we've got a few people online. What I want you to do is just put into the question section what you think the share market could be at in 3 years' time. Just quickly type it in what you think it will be in 3 years' time. Well, we're currently at 4,500 points approximately. Do you think it'll be up? Do you think it'll be up at 6,000, 7,000? Well, while you're putting in those details, what I'm going to do is actually mention or read from an email I received a few months back from Charlie Atkins. Charlie Atkins is a well-regarded investment manager and research analyst that works at one of the large stockbroking firms here in Australia. He started the email by saying, "Welcome to day one of the next 5-year bull market in Australian equities. I'm setting a domestic equity strategy for an ASX200 target of 4,500 by year's end." So it's at 4,500 already. This was 3 months ago, so the market's up about 7% since it came out with this article. By the end of June 2013, he expects the market to be at 4,800 points. If we look at it, he's going through. He also makes a comparison to the two. I'll send you all this report. He believes that if I read directly from his article, I believe all the ingredients are in place for a major rally in the Australian share market. If the China data is better, the commodity price is higher, and the majority of miners have wound back capex intentions, you'll get a 25% rally in the leading Australian resource stocks off this low base. So it's very bullish about the Australian economy and especially the Australian share market. So you look at where we're at, the economy is looking pretty good. What we need to happen is the fear that's in the marketplace to be eroded. And eventually, hopefully over the long term, that will occur. As soon as the media stops writing about Greece or the slowdown in China or the problems that the United States face, the better our market will reflect the fundamentals of the overall economy. So a few people have put in some quotes. We got there from 5,500 from Mike, 6,700, 6,200, 4,500 if we're lucky. If you believe the market can rally, what are we talking about? Above 5,200 points, then you'd be better off participating in the roll down. You will make money from the investment. If you don't think the investment or the ASX 200 is going to go up over the next 3 years, then you're better off just wiping your hands clean and walking away. And that are your two options. So where to from here? As the investment's approaching maturity, you need to make a decision. You need to make an informed investment decision, which is why I've put the webinar on. 1, walk away. 2, roll down. Now, if you walk away from the investment, you are walking away from any upside recovery in the market. You are locking in the loss, which is the interest expense. There's no way you can recover that loss back. If you participate in the roll down, what you're doing is reinstating the investment at the current market level, or what will be set at the 19th of December. So if it's still at 4,500 points, that's where we'll be fully exposed to the ASX 200. Over 3 years, you get to enjoy any capital growth of that investment, or if you decide to redeem early, when you decide to redeem. To keep the investment, you again need to prepay another 3 years of interest up front. We're waiving the application fee, so 3 years interest up front is 4.95%, so the total outlay for a $100,000 investment is $14,850. Your initial outlay for the first 3 years was $15,700. So it's about $1,000 cheaper per 100 grand for the next 3 years. So where we're at, look, the economy looks better, the fundamentals are looking better than where we were 3 years ago, the market's cheaper, and the cost of keeping the investment is lower. So from an investment perspective, it's looking even better than where we were 3 years ago. So let's look at the process of a roll down. The roll down is simply described in my book, The JB Way. If you haven't read it, I encourage you to do so. You can download one by just speaking to your investment manager, or sending a link. I'll send you a copy of the book. So let's just look at stock. Let's say we buy it $10 at time 1, so this period here. Let's say we get it wrong. Over 12 months, the market goes to $5. Now, because you've all had the foresight and understand the benefit of capital protection or insurance on your shares, what it means is at time 2, rather than selling at $5, you can sell it at $10. So what that means, if you started with one share at $10, you had $10 to invest, it went down to $5, you get your $10 back by initiating the capital protection feature. Now, at time 2, you can simply walk away from the investment. You get your $10 back. Thanks very much. Go put it in a bank account now, which will earn you 3%. By the time you take the bank fees, probably bugger all. Alternatively, what we can do is, if we still believe in the underlying investment, rather than buying one share at $5, we've now got $10 to invest. So we can invest and buy 2 shares at $5 for the $10. Again, have capital protection. So the benefit of this is the benefit of hindsight. You get the benefit at time 2 to sell at time 1 share price, the purchase price, even when the market has halved in value. Time 2, you buy twice as many units. So if the market goes up, you make money. If the market goes down, you make units in the investment, or shares in this case. Market rallies back at $10 at time 3. You now own 2 shares. 2 shares at $10 means your investment is not worth $10 had you initially held it. Through that time, you've actually doubled the investment amount, so you're worth $20. So you started with 10, the share price is still the same, your investment is now worth $20, simply because you had capital protection and you participated in the roll down at time 2. So where we're at today is hopefully time 2, hopefully. So this is an example of ASX, a real life example on the market for ANZ share price. ANZ back in 2007 was trading at $30. If we purchased 10 shares at $30 plus protection, it's cost us around 300 grand. GFC hit, obviously all banks fell. The share price of ANZ fell to $15. At the maturity of that protection, we received dividend income at the time. We can sell it at $30. So even though the share price is halved in value, we just go, thanks very much, we're going to exercise it at $30. We get our 300 grand back. At that time, many people had the option of rolling down or putting money in the bank account at interest rates at around 3%, like we are today. Many people put it in the bank account, and by doing that, they didn't get the capacity to enjoy in any profits as the market rebounded. The majority of people put it in the bank account. They didn't participate in the roll down. Now they've got 300 grand. At 300 grand at $15, they can in fact buy 20,000 shares by fully utilising that 300 grand investment. Again, have protection. At the maturity of the option, the second option, the share price of ANZ has gone back to $25. So we now own 20,000 shares because we had capital protection initially and we participated in the roll down. 20,000 shares at $25 is worth 500 grand. Our initial investment was $300,000 and it's now worth $500,000 at the maturity of the investment. Yet the share price is still trading $5 below the initial entry level. The people that remained patient long-term investors like Warren Buffett were able to make a huge return on their investment despite the volatility in the marketplace. We love volatility, right? Volatility is great because we've got capital protection, and if we participate in active management, we can roll down and increase the number of units we own in the investment. So the investment now, if you had 100 grand invested, you had 100,000 units initially at $1. The new issue price is 90 cents. So you're in fact increasing the unit price, the number of units held to 111,111, I think it is. So you increase the units because the market has gone down in value, which increases our return if you participate in the roll down. So those are the key features. We're re-entering the market at the lower level. If we entered the market today, it would be at 4,500. As I said, the date is the 19th of December. We extend the investment term by 3 years. By extending it by 3 years, we can be patient long-term investors and give the market time to reflect the fundamentals, that is profit. You've got to prepay interest for another 3 years. The interest rate is 4.95%, which is $14,850 for a 100 grand investment. Now, 100 grand is not the maximum, it's not the minimum. In fact, for you guys, we'll do whatever you like as a minimum. You don't need to maintain the investment amount that you had. You can increase the investment amount, which many people are looking at doing, or reduce it. We're happy to be completely flexible to work with you guys that have been loyal investors over the last 3 years. We'll waive the application fee again. We're just trying to remove all of the usual obstacles there are of investing. To give you the capacity to maintain investment and hopefully make a profit from investing with us. Again, you must borrow 100% of the investment amount. It'll be capital protected for the loan amount only, which means the interest obligations will be the maximum amount you can lose if it doesn't go up. The loan, again, is limited recourse, which gives us the capital protection on the insurance provider. We expect the person that's providing the hedge will be an investment-grade bank, so again, the likes of Merrill Lynch, Morgan Stanley, Deutsche, UBS, so it's an investment-grade bank. These are the top banks in the world. Variable participation rate, again, with the potential of a maximum of 150%. What that means, because of volatility, is at the moment the actual participation rate is close to 150%. So the market goes up 10%, we can make 15% on our investment, so it can enhance the investment returns. Conversely, if the market goes down 10, we can lose 15. But that's sort of insignificant because if it's down 10 or 15, it's the same result for us as an investor in that we've got capital protection. Now we'll be paying out a contingent coupon. Now it's contingent on performance each year, the first and second year of up to 10.8%. So we're sort of harvesting the growth as we go. The final payout in 3 years' time will be any growth over the 3-year period less the coupons you've been paid over that period. So the key risk, look, obviously there's no guarantee the units will generate a return, let alone in excess of the interest expense. As I said, it needs to go up the investment by 4.95% per annum for you to make money. While investment amount is capital protected, your interest expense is at risk. That's the maximum amount you can lose. The return is affected by the performance of the ASX200 plus the volatility of the investment. Counterparty credit risk, that is the investment grade bank. And obviously gains and losses may be magnified by the use of the 100% loan. That is, the more amount you invest, the greater the interest expense, therefore the greater the dollar risk. So let's look at an example. This is actually an example of 100 grand, not 200 grand, so it's an error over here. So it's $100,000. Your initial investment, you had 100 units. You had 100 grand limited recourse loan. So we're going to roll down to an issue price of 90 cents. Which means the number of units you're going to own is 111,111 if you maintain the 100 grand investment loan and investment amount. You need to prepay 3 years of interest up front, which is 4.95%, which is $14,850. Application fee, well, that is going to be charged for new investors, but we're going to waive it for you guys. It means the total outlay for the entire 3 years is $14,850. So let's look at two scenarios. One if the market goes down 60%, one if it goes up 50%. So investment falls by 60% over the 3-year period. Your initial investment amount is 100 grand, initial loan amount 100k. If it goes down by 60%, the investment value at maturity will be 40 grand. You get the benefit of capital protection, which means the maximum you lose is the $14,850. Now that assumes the market falls day one, never goes up. If it did go up for the first 12 months, you may get a contingent coupon and then falls. So by getting income along the way, it increases the potential returns and reduces the risk over the period. So the final coupon will be nothing. Performance fee will be nothing, so the total loss will be $14,850. That is if the market goes down by 60%. Let's talk if it goes up. If it goes up by 60%, your investment's going to be worth 160 grand. Your initial investment amount would be 100. Your first coupon will be 12k, second coupon 12k, total final coupon 36k, which gives you a total return of 60 grand. Hopefully I'll be paid a performance fee, which is 6 grand for making that return. So you get paid $54,000. So if it goes back to those highs that we were at 2007, now market, now investment goes up 60%, we're making a good return on investment. For us today, you're outlaying $14,850. That $14,850 will be worth 54 grand if it's up 60% over that period. So the return on the investment is huge. Let's say it only goes up half that. Let's say it's the longest, most painful recovery in history. If it goes half that, what are we talking about? A $27,000 gain. So your $14,850 will be worth 27 grand if it goes up around 7% per annum. So you've still got high returns, especially if you consider your return on your investment or your return on your at-risk capital. Now again, what we're wanting to do is give you the capacity to make a return from your investment, not just to make a return on the $14,850, but also hopefully to recover the investment that you've outlaid for the first 3 years. So the Warren Buffett way, never lose money. Number 2, never forget rule number 1. For you to never lose money on this investment, you need to be a long-term patient investor. First and foremost, you have to believe in the underlying investment. What we're talking about here is the top 200 shares on the Australian share market. So made up line share of BHP, Rio, the top 4 banks, Wesfarmers, Woolworths. This is a true reflection on the Australian economy. If you're a believer in the Australian economy, then rolling down makes sense. If you don't think the Australian economy is going to go up in value, then maybe it's time to cut your losses and look elsewhere. So it's really up to you to decide that. That's a decision you need to make. We need the market to go up 4.95% per annum for you to break even. And if you look at the last time the RBA dropped interest rates to 3%, our share market performed very strongly following the 3 years. Now personally, as I said a few times tonight, look, I believe our Australian share market is fundamentally undervalued by a significant amount. We just need the market to reflect those fundamentals, which is profit, as opposed to the noise in the marketplace. It's becoming very frustrating hearing the same news about Europe and Greece plaguing our market here in Australia. If our share market catches up to the United States share market, then we're all in for a good return over the next 3 years. And I have no idea why the Australian share market has underperformed the United States share market over that period. So what I'll do, I'll pass over to you guys for questions. The next step is that you have to get the product disclosure statement. The investment cut-off date is the 14th of December because we need to trade on the 19th of December. So again, you don't have a huge period of time, but we have to lock these interest rates in, lock in capital protection for the 3-year period. We want to ensure that you maintain 100% exposure to the share market throughout the period. If we wait to the close date, we don't want to take the risk of a gap in that we miss out on any rebound of the market in the short term. So the cut-off date is the 14th of December 2012. So if you want to organise a meeting, then contact your investment manager. If you're not too sure who your investment manager is, by all means give our office a call and we'll be able to put you into contact with the investment manager here at Sequoia. There's questions there if you'd like to put in some questions. In fact, if you want to be contacted, by all means put in the question section now your details and we'll get in contact with you within the next 24 hours. We've got a few questions. What is the minimum investment amount? There is none. For you guys, it's usually 50 grand or $7,500 out of your back pocket. But again, we just want to give you some form of exposure to the marketplace. Another question, do I need to roll down the same investment amount? No, you can increase the investment amount. You can also reduce it. It's up to you. The third question, as the market is cheaper and the interest rate lower, isn't it an even better time to be buying? Yes, I agree. That's the overall pitch and the story of tonight. Can I invest using super instead of my own name? Yes, you can. Why wouldn't I do this? Well, you do need to outlay the interest expense for the 3-year period. So if you can't maintain the investment exposure because you need to outlay that interest expense, then that would be the reason. The only other reason is if you don't believe the ASX will go up. Need to include the loss in the initial investment projections. Well, at the moment, look, that is a loss. If you look at the deductions, it's up to you, your tax bracket. From here, you need to make a decision, because if the market goes up 3% per annum, you're recovering, or sorry, if it goes up 7% per annum and the return is 25%, from the decision you need to make today, you are $10,000 better off per 100 grand investment, as opposed to just walking away from the investment. So the decision you need to make today is hopefully going to recoup all of those losses and make a gain. For us to include those losses as well, we need it to go up around about 10% per annum. Can you pay the interest expense up front out of your SMSF? Yes, you can. You can pay it out of your self-managed super fund. What was the RBA cash rate when you got a loan at 4.5%? It was about these levels, maybe slightly higher. Current RBA interest rate is 3%, the lowest ever. Why are we paying 4.95%? Well, it's interesting because we get off a bank. The bank charges a margin. They're taking a risk, and also that interest expense includes the cost of protection. The capital protection cost over the period needs to be included. So when you include the protection cost as well as the cost of borrowing, it is very cheap. What else are we looking at? We've also increased the capacity of you earning an income, so it's gone from 7.2% up to 10.8%. So hopefully it's the ability to increase the returns. But at 4.95%, that is cheap. I'm not too sure of any other banks that are willing to lend on equities at anywhere near that rate, let alone being capital protected, which is a key component, obviously, of the investment. Cheaper than a mortgage. So thanks very much again. Look, put your details into the question section if you want further information about the investment. Series 1 roll down, plenty of people took advantage of the Series 1 roll down, and the current investment is up since they did it. It's up within 3 months of pretty much the first year interest expense, which is good. So it's on its way to a recovery. So all I hope that you can do today is be a patient long-term investor. Again, a good investment manager can implement risk management. We invested risk management for capital protection, also by giving you access to very cheap interest rates. That obviously reduces the risk over the investment term. So we've controlled the risk management. It's worked the way it was designed. Unfortunately, what we couldn't control was the market. And the market, for whatever reason, is below our initial entry level. Hopefully, to enjoying the rebound, you will be a patient long-term investors. What I do know is if you redeem, then obviously there's not going to be any profit ability. You will be walking away from the market and the investment, which will be disappointing if there is a rebound. The only thing frustrating about making a loss is to actually exit an investment to see it rally a lot after you decide to sell. What else have we got? By extending the investment for 3 years, you're giving yourself potential making a return on the investment. So by rolling down, you have the capacity to make a profit, hopefully a substantial one. All good. So look, hopefully it's been informative, and you guys can get a bit of information with your investment managers following this. Excellent. Thanks very much. don't forget to insert your details if you're interested in being contacted.